Those giant green containers you see stacked at ports around the world belong to Evergreen Marine Corporation. This company once rode globalization to the very top of the shipping industry. During the pandemic, it made billions while supply chains were in chaos. Investors celebrated. Profits exploded. Everything looked unstoppable. But now the story has taken a sharp turn. Why did a company that earned so much from mainland China suddenly place a $4 billion ship order entirely outside the Chinese mainland? Is it true that its logistics network may have been linked to U.S. weapons shipments to Taiwan under the Taiwan Relations Act? And could political tensions start affecting where its ships are allowed to dock? It isn't just about shipping anymore. It's about strategy, risk, and whether Evergreen can survive in a world where trade is no longer trade. When people talk about global shipping, one name that almost always comes up is Evergreen Marine Corporation. If you've ever driven past a major port anywhere in the world, you've probably seen those massive green containers stacked like Lego bricks, each stamped with the bold word Evergreen. For decades, that name stood for reliability, scale, and serious money in the container shipping business. But in recent years, the story around Evergreen has become a lot more complicated. What used to be a straightforward success story, from a single aging vessel to a global logistics empire, is now tangled up in geopolitics, cross-strait tensions, supply chain realignments, and some very controversial decisions about shipbuilding and military cargo. Let's unpack the full picture: how Evergreen rose with the help of the mainland market, how it became a global giant, why its recent decisions triggered backlash, its rumored role in transporting U.S. arms to Taiwan, whether it will face real trouble in mainland China, and what its financial trajectory tells us about its future. Evergreen's story begins with its founder, John Ewing Farr, a man who started with almost nothing. In 1968, he launched Evergreen with a single-use cargo ship. Back then, Taiwan's economy was growing fast, and global trade was expanding. John had the right instincts at the right time. Over the next few decades, Evergreen didn't just grow, it exploded. It expanded routes across Asia, then to Europe, North America, and beyond. It built a reputation for punctuality and standardized container systems. Eventually, Evergreen became one of the world's largest container shipping giants. At its peak in the 2010s, and especially during the pandemic years, Evergreen ranked among the top global carriers. But here's the key point that often gets overlooked: a massive chunk of Evergreen's profitability came from the Chinese mainland. For years, China's coastal ports of Shanghai, Ningbo, Shenzhen, and Tianjin were among Evergreen's most critical operational hubs. China is the world's manufacturing powerhouse. If you move goods globally, you move goods from China. It's that simple. According to industry estimates and financial disclosures over the years, a very significant portion of Evergreen's revenue was tied directly or indirectly to mainland export routes. Some analysts have estimated that at certain points, as much as 60 or 70% of Evergreen's profit was linked to mainland-related trade flows. During the pandemic, this dependence became even clearer. While many ports worldwide were paralyzed, Chinese ports reopened quickly. China's manufacturing also recovered earlier than in Europe or North America. Freight rates skyrocketed. Shipping companies made record-breaking profits. And Evergreen? It was one of the biggest winners. In 2021 and 2022, Evergreen posted record earnings. In 2022 alone, the company reported net profits exceeding $10 billion at the time, riding the historic surge in freight rates. Shareholders received massive dividends. Some retail investors in Taiwan even became overnight millionaires. Much of that windfall was fueled by China-origin cargo. That's why what happened next shocked so many people. In 2023, Evergreen announced a massive shipbuilding order, 24 methanol dual-fuel container ships, each with a capacity of around 16,000 TEU, valued at roughly $4 billion. Given China's dominant position in global shipbuilding, many expected at least part of that order to go to Chinese shipyards like Jiangnan Shipyard or Hudong-Zhonghua. Chinese shipyards have become highly competitive in the construction of large container vessels. Pricing is often lower than Korean or Japanese yards. Delivery times are increasingly shorter. Technological capabilities, especially in LNG and alternative fuel vessels, have advanced rapidly. But Evergreen awarded 16 ships to South Korea and 8 ships to Japan. 0 orders were placed with the Chinese mainland, even though the price was 15% lower and the delivery lead time was 3 months shorter. Officially, Evergreen cited commercial considerations. Unofficially, many observers saw it as a deliberate diversification away from China's industrial supply chain, or even a geopolitical calculation. From a purely business perspective, diversification isn't irrational. Shipping companies reduce risk by spreading exposure. But timing, context, and perception matter even more. Because by then, cross-strait relations were already tense. Another sensitive issue involves Evergreen's alleged or indirect involvement in transporting U.S. military equipment to Taiwan. The United States remains Taiwan's primary arms supplier under the framework of the Taiwan Relations Act. Over the past decade, Washington has approved multiple major arms sales packages, including missiles, radar systems, and armored vehicles. While military cargo is often transported via specialized defense logistics contractors or chartered vessels, commercial carriers can play indirect roles in supply chains, especially in dual-use logistics. There have been media reports and industry speculation that Evergreen vessels, or Evergreen-affiliated logistics networks, have been involved in transporting U.S.-origin cargo linked to Taiwan's defense procurement. Even if Evergreen is not directly shipping military missile crates, the political optics matter. In Beijing's view, any company facilitating U.S.-Taiwan defense ties is crossing a red line. China has repeatedly warned that foreign companies assisting military cooperation between Washington and Taipei could face consequences. Although Evergreen is not a foreign company in Beijing's eyes, the company has to be disciplined if it delivers U.S. arms to Taiwan. So far, there is no public evidence of formal sanctions on Evergreen. But the geopolitical risk premium is real. The story of an Evergreen vessel stranded outside Tianjin, reportedly drifting for weeks without docking, became symbolic in some narratives. Shipping is extremely sensitive to regulatory friction. If port inspections become stricter, if customs clearance slows, if berthing priorities shift, costs escalate fast. A large container vessel burns tens of thousands of dollars in fuel per day. Port fees can exceed $100,000 daily in some cases. Delays ripple through global schedules. Even small policy adjustments can significantly impact a shipping line's margins. Whether every online anecdote is fully accurate, the broader point is clear: Evergreen's relationship with mainland authorities and customers has become more fragile. And that fragility shows up in financial data. Let's look at the numbers. During the pandemic freight supercycle, revenue surged, net profits reached historic highs, cash reserves ballooned, and debt levels improved significantly. Evergreen distributed record dividends. Its stock price soared on the Taiwan Stock Exchange. As global freight rates normalized, container spot rates collapsed from pandemic peaks, global trade slowed, and overcapacity emerged as new vessels entered service. Evergreen's 2023 net profit fell dramatically from 2022, remaining positive but nowhere near peak levels. By 2024, margins tightened further. It wasn't unique to Evergreen. The entire container shipping sector experienced normalization. But companies with strong mainland China exposure faced an added layer of uncertainty due to geopolitical friction. Now, we need to answer a question: will Evergreen have a hard time in the Chinese mainland? Indeed, it is a big question. There are several possible scenarios. Scenario 1: China remains pragmatic. Mainland exporters still need competitive shipping capacity. Evergreen remains a major global carrier. Business continues, albeit with less warmth. In this scenario, Evergreen loses some market share but remains operationally active in China. Scenario 2: mainland cargo owners increasingly shift to Chinese carriers like COSCO or other global lines seen as politically neutral. Evergreen's port access becomes increasingly bureaucratic. Profit exposure declines steadily over 5 or even 10 years. Scenario 3. In an extreme geopolitical escalation, especially if cross-strait tensions escalate to the military level, Evergreen could face formal restrictions. That is unlikely in the near term because shipping is deeply integrated. But the risk is not zero. Right now, Scenario 1 or 2 appears more realistic than Scenario 3. Evergreen isn't just a shipping company. The broader Evergreen Group includes aviation, EVA air, hotels, logistics, and leasing services. Its airline arm, EVA Air, remains a strong global brand. Diversification provides resilience. The methanol-fueled ship order also reflects the environmental strategy. The International Maritime Organization is tightening emissions regulations. Alternative fuels are the future. By ordering methanol dual-fuel vessels, Evergreen is positioning itself for the green transition. That's a long-term strategic positive. However, the global container shipping industry is consolidating. Mega alliances dominate. Fleet scale matters. If Evergreen's mainland exposure weakens, it must compensate by growing in Southeast Asia and South Asia, attracting customers from Vietnam, Indonesia, Malaysia, and even India. It may need to pay more attention to nearshoring routes, such as from Mexico to the U.S. Trans-Pacific trade and Europe-Asia corridors are also options. Fortunately, global trade is diversifying away from reliance on a single country. That could benefit Evergreen if it adapts quickly. Still, the Chinese mainland is the largest trading partner for over 120 countries, so a good relationship with Beijing is vital to Evergreen's future. Can Evergreen earn Beijing's trust and retain mainland customers? It is still an open question. Evergreen has strong balance sheet reserves from pandemic windfalls. It is not financially fragile, but its profit margins will likely never return to 2022 levels unless another freight supercycle happens. Evergreen's story is no longer just about shipping. It's about geopolitics colliding with globalization. It grew rich in an era of integration. Now it must survive in an era of fragmentation. Founder John Ewing Farr understood mainland engagement as a growth engine. Today's management operates in a world where political risk calculations are unavoidable. Shipping used to be about freight rates and port efficiency. Now it's also about flags, alliances, and military supply chains. Can Evergreen survive? Absolutely. Will it thrive the way it did during the pandemic boom? Unlikely. Will mainland China shut it out completely? Also unlikely, unless tensions spiral dramatically. More realistically, Evergreen enters a new phase, less dominance. More caution. More diversification. More geopolitics. The green containers will still sail the oceans. But the waters are no longer purely commercial. They are strategic. And in 2026 and beyond, that changes everything.